So, are you looking for a way to scale your real estate portfolio and you are curious about doing it with multifamily, but you might be wondering, is now a good time to get into that market? Well, the answer is yes, in short. Right now, we're in a great market to invest in multifamily real estate because the returns are just as strong as 2 years ago, but with way less risk. So, to understand this, you have to understand the idea and philosophy of risk adjusted return. In this video, I'm going to explain what that is and why it should matter to you if you want to get started with multifamily, and understand why now is an amazing time to get into the market for yourself, but also your investors. Hey, I'm Michael Blank, and I help people achieve financial freedom through real estate. Let's do this. All right, so why is now a great time to get involved in multifamily real estate? Let's understand risk-adjusted return. So the return part is pretty obvious. It's some kind of money I'm going to make. And then risk is, well, how much risk am I willing to undergo to get that return, right? So it kind of measures an investment's return relative to its risk. For example, crypto might offer 50%, 100% return, but a very high chance of losing everything. Versus, for example, money market has a very low return, but also a very low risk as well, right? So there's always the trade-off between high return and high risk, etc. And so you have to understand kind of in the spectrum of all the things you can do when you're trying to figure out where you're going to invest, what you're getting involved in, you're really looking for something that offers the right mix of risk-adjusted return, which is really like multifamily in general. Multifamily in general tends to have fairly high returns, but also fairly low risk. Now, why do I say fairly low risk? Number one, as is evidenced by how much leverage and loans you can get from institutional lenders that will give you a very high leverage loan, very low interest in the scheme of things compared to any other loan you can get. You're still getting it in the mid fives, right? Mobile home parks, nightclubs, restaurants, right? Low leverage, very high interest rates. Furthermore, a lot of them have interest only for the first 3 years. That's wild. Interest only loans, and then they're not personally guaranteed. And the reason all this is happening in multifamily is because these lenders associate multifamily as relatively low risk because of the way it's performed over the last 5 decades or even more. And no, what about the returns? The returns are actually really good. They're above average, above the stock market. Typically, a multifamily deal offers 15 to 20% average annual return. Typically, stock market somewhere between 8 and 12. There's also cash on cash return that they offer, right? So it has a really, really good mix of a risk-adjusted return versus maybe some other things that you might be considering. Now, let's talk about, though, why now is a better time than 2.5 years ago, and it's because of this risk-adjusted return. So the returns, as I said earlier, they're about the same as they were 2.5 years ago, still about 15 to 20% average annual return, 6% cash-on-cash return, great tax benefits, but the risk has changed quite a bit. So within the multifamily risk spectrum, which I told you is now a little bit lower versus other real estate strategies you might be considering, or the restaurant business or some kind of franchise, within that lower risk spectrum, 2.5 years ago, it was really swung to the higher end of that risk spectrum. And because several factors. One is the leverage we were using 2.5 years ago was much, much higher than today. So back 2.5 years ago, we were getting 80% loan to cost. That means you're not just getting 80% of the purchase price, but you're also getting 80% of fees and any kind of construction. So it was historically very high leverage. That's, of course, riskier. Today, we're getting much, much lower leverage. Today, we're getting 6 to 9 months ago, a 65% loan to value, meaning you're getting 65% of the purchase price, but you're not financing any kind of fees, and you're certainly not getting any construction loans either. And today, we're maybe around 75 loan to value. Again, no construction loans whatsoever, so we're using much lower leverage, which means that the risk is lower as well. The other thing that's different is that the interest rate outlook 2.5 years ago was up. Everybody agreed it would go up. Now, no one had any idea it would go up 11 times in a row, but the prognosis was up, which of course is a bit bearish. We're like, well, we just solved this by assuming higher interest rates when we refinance or sell, problem solved, right? Still, rising interest rates means that prices are going to go down, which is exactly what happened. Now, however, the prognosis in interest rates is flat to down, right? And so therefore, it's a more bullish outlook because if the interest rates are flat or down, prices are going to go up. Also, I don't even need the interest rates to go down per se. As long as I have stable interest rates at wherever they are, 7-8% doesn't really matter. As long as they're stable, banks and lenders will now associate that level of stability with less risk. Therefore, their leverage will start to go up. Yes, at a higher interest rate, but their leverage will go up. That also will drive prices up. So the big difference here is that back 2.5 years ago, because of the interest rate outlook where we are right now, prices were projected to go down historically, just go down. Right? Everybody knew that, just didn't know to what extent it would go. Now, the prognosis is more that prices are going up because we have interest rates that are going down, and also the leverage will start going up as we stabilize this environment. So this makes literally this market cycle typically takes 5 to 10 years to happen. It happened in just 2 years. It's crazy. And so this is why it reminds me a lot of 2008, where people were just running away from real estate. There's blood in the streets, real estate bad. And then the really sophisticated investors, 2008, 9, really started backing up the truck and buying real estate, which was, of course, on sale. And that's kind of what I feel right now is prices are off 3 to 40% in many cases because of the fear, because of the interest rate up, because the leverage went down. But that's not a normal market environment, right? The more normal market environment has been vastly different over the last 50 years. And this is why I'm saying this is a great time to get in there. I don't advise that you time the market. In general, you should always try to get into the market and adjust your tactics going into it. But if I were to time the market right now would be a really good time to time the market. The other thing I like about multifamily is its long-term outlook. I just really like the demand. And this has not changed even 2.5 years ago. The demand for multifamily has always been stronger, and that is because we have a housing shortage in America, number one. And number two, it has been over the last 3 years much cheaper to rent than to buy. And there's normally a difference between the two, but the last 2.5 years, 3 years, that discrepancy has grown dramatically because the cost of homeownership has really become very, very extreme, forcing a lot of people to rent. Now, while that is not good for the general public, it is very good for rental property. And so because of the cost of capital right now, builders have not pulled permits over the last 18 months. They've been down by 81%. Developers are not pulling permits anymore because they can't make money at the cost of capital. And so back in later in this year, in 26, there's really nothing else coming out of the ground. All of that is going to exacerbate this problem of a rental property shortage for affordable housing. Again, while not good for the general public, it is very good if you're holding rental property. So I like this combination of a reasonably high return with a much lower risk than we had 2.5 years ago. That's really what I wanted to share with you right now, that despite of what you hear or have heard, the market has swung crazily in the other direction in a positive way. So take a closer look at the multifamily strategy. It is really the only way to scale your real estate portfolio. You can't do it with flips or with rentals. You got to do it with multifamily. It is the best way to do it. And the cool thing is you don't need a decade of real estate investing experience, and you don't need to use your own money as well. So if you want to learn more about this multifamily investing to scale so you can become financially free, then check out our free masterclass. It's called Apartments 101. Apartments101.co is the place to go. Just look for the link somewhere down below and just check that out. It's a 45-minute long training video that introduces you into the whole world of multifamily investing, especially if you're coming from a single family investing background. So here's the financial freedom. Catch you guys next time.